Thank you so much, David. It's great to be here in Sydney. I came here last about 2 years ago, and I think we maybe have double the attendance this time around at AltFi, which is fantastic, and I think indicative of the growing opportunity here in Australia for alternative lending, online lending, marketplace lending, whatever term you want to use. It's a very, very exciting time, I think, to be in Australia, to be in this market. So without further ado, the subject of our talk, because it is on deck and we do focus on small business lending, we are going to focus on that today. So online SME lending in Australia, growing fast and growing up. Make sure my headset is sorted out here. Okay, we'll start by doing a little bit of benchmarking against the U.S. I think we've been working on this in the U.S. now for quite some time, over 10 years. And what we found is that there's a certain market cycle that you go through. And I think what's exciting about Australia is you guys are going through that cycle even faster and more aggressively than we did in the U.S. Then we're going to talk about positive forces in online lending for Australia. Should I switch? Good? All right, good. So we'll talk about the positive forces that are driving the growth of online SME lending in Australia, and then finally talk about where we're going over the next few years as we head towards 2020, and what we think will be just a very, very exciting time for this market, for this industry. So let's talk about the U.S. in our first decade there. We made the first online loan to small businesses back in 2007, and we really did have an initial couple years of what I would just call low awareness. No awareness on the part of small business owners, on the part of mainstream bankers about this type of solution. And then we went from that phase into what I would call the skepticism phase. We had just come out of the global financial crisis, and there was a lot of sort of negative feelings about anything that involved expanding access to credit after what had happened in the U.S. with subprime mortgages and so forth. But then as these players started to get some traction, you see the inflection point there in OnDeck's originations, we went into the stampede phase where tons of capital, investment, new players, and explosion of innovation happened in the market. And I think now in the last 18 months, what we've seen is just like any new industry, that stampede is followed by a shakeout. The stronger players survive, the weaker players die off, and then the industry enters what we would call a maturity curve, where the technology, the product really goes mainstream. And at this point, OnDeck in the U.S. has delivered over $8 billion to small businesses. We're on track to deliver around $2.5 billion to small business in this year alone. And what you're seeing, and I'll show some slides on this in a minute, is just how common and aware the U.S. customers now are of these types of offerings. So let's contrast this with Australia. So the Australian market, we believe, is on a very similar path, but it's happening much faster. So when we expanded to Australia, that was only just now a couple years ago. I think our first loan was in November of 2015. And the low awareness phase began at that point. Certainly skepticism is something you're going to see as well in the market as we build this technology, build these solutions up. But we are now entering the scaling phase, and I'll show you some of the market data now on how originations are growing now year over year at an exponential, geometric type rate. Eventually there will be some kind of shakeout. David alluded to the fact that we're later in the economic cycle. I don't know if the economic cycle and the shakeout in this market will coincide, but certainly that will happen as we go on our way to maturity. But if you sort of look at this start to finish, we're talking about 5 or 6 years here, where the U.S. traversed this probably in call it 12 years. And so I think what that means is, in a good way, Australia, I think, is learning from some of the experiences in other markets around the world, is evolving faster, and ultimately that's a good thing, I think, for both the players in the industry as well as the small business owners themselves. So speaking of the small business owners, let's take a look at some data here comparing where U.S. Small business owners are about alternative finance and where Australian small business owners are. So what you see here, and I'd like to call your attention to the graph on the left here, compared to 5 years ago, this is really interesting. 70% of U.S. small business owners perceive that there are more small business lending options today than there were 5 years ago. That is a remarkable statistic, and that shows just how mainstream this type of financing is becoming. In Australia, we see that number is only 30%. So there's still some work to do. We're sort of out of the low awareness phase. The good news is many small business owners, 30% is not a small number, but there's a lot of opportunity to close that gap with the U.S. And what's really interesting is that in the U.S. and also in Australia, for the small business owners who said we are aware of more options in the market, 97% in the U.S. and 93% in Australia said that was a good thing. So just like you go to the supermarket, you might see 2 different options of jam, let's say, on the shelf, and then you might see that replaced by 5 or 6 options of jam. Most consumers would say That's a very, very good thing. This is not dissimilar. More choice in general is better for small business owners. More competition in general is better for small business owners. So we're seeing a real opportunity here to continue to grow that awareness in Australia. Now let's also look at the top reasons small businesses seek out loans between the two markets. And what you'll see is that they're strikingly similar. So in the US, our number one reason is location expansion. That could be a remodel, could be adding seating to your restaurant. It could be actually opening a second or third restaurant. Managing cash flow at number 2, equipment purchase at number 3. So 2 out of those 3 reasons also show up in the top 3 for Australia. So 40% purchasing equipment, 36% managing cash flow, 32% inventory purchase. And what I believe is if you actually expanded this to the top 5 reasons as opposed to the top 3, you would see even more overlap between the markets, because we know that at OnDeck at least, many of our customers use our loans to purchase inventory, so that's a very common use case as well. So lots of very important financing needs these businesses have periodically, and that's where online financing really fills that gap in the market. Who plans to seek out financing in the next 12 months? The US, it's about a third of businesses there, Australia 25%, and if you are going to seek out financing in the next 12 months, how many will consider an online lender? And here the markets are actually not that dissimilar. So nearly 40% in the US, 33% in Australia will consider an online lender. But as an industry, our job over the next few years really is to bring these numbers up. We really want any small business considering a loan for almost any use case to consider an online lender as a viable alternative to a traditional bank. We do have some interesting data here about Australian SMEs and their need for better financing. So 1 in 5 SMEs said they were actually unable to take on new work because of cash flow restrictions. And 9 out of 10 SMEs said that better cash flow could improve their revenue by an average of 11%. And so again, you multiply that times the total number of SMEs in the market, you get a really nice opportunity to grow the economy just simply by providing better access to capital. And then you sort of look at who actually used alternative lending options. So you saw that about a third of businesses would consider using an online lender, but only 9% have actually tried it. So again, a huge amount of what I would call potential energy in this market. As the awareness continues to go up, the actual adoption continues to go up, there's no reason to think, and we'll show you some data later on this couldn't be a market that's 5, 10, 20 times its size today in just a couple years. And the other thing that's really important, and sometimes people wonder, well, why did OnDeck and some of these other online lenders succeed in the US? When banks, and there's 6,000 banks in the US, when there's so many options out there for small business owners already. And a big part of it is product market fit. So when you look at what you actually need to have as a small business owner to get a bank loan, in a lot of cases, especially here in Australia, it has to do with how much property you own. And many small business owners the business is a means to economic success. And they're not often born with the silver spoon in their mouth, so to speak, or with a very expensive Sydney apartment on their books already. The business is a means to achieve that. So lending on the strength of the business as opposed to the strength of the assets of the owner is a very big shift. And that's what these online lending products are able to do. Furthermore, there's a lot of substitutes out there that are imperfect for the use case at hand. So many small business owners, when business credit is not available to them, turn to personal products. They'll borrow against their home, or in many cases, they'll just use personal credit cards. But that product is not always the best fit. You might have a $10,000 or $20,000 limit on your personal credit card, but your business needs $50,000 to buy an oven or a piece of equipment. And that personal credit is just not going to flex up for the needs of your business. So overall, still a ways to go. But Australia has some very, very strong trends that are going to support the growth of online small business lending. And so some of these are positive and growing fintech adoption, a favorable macro environment, at least for the next, hopefully, 12 to 24 months, a supportive government, a government who's taken a very active interest in this sector, and self-regulatory efforts among the industry participants. So let's just talk quickly about each of these. In terms of fintech adoption, Australia is growing faster than most of the global markets, and it's now actually outpacing the US. Which actually doesn't totally surprise me. And if you look at Asia, Australia is now the second largest alternative finance market in the Asia-Pac region. And if you look back at 2013, alternative lending in Australia is 25 times the size it was in 2013, which is an absolutely staggering number. So the adoption is there. The other thing about this market that's very interesting is psychology really does drive a lot of behavior. And we see this in the US. As we came out of the global financial crisis, small business owners were not optimistic. They were pessimistic, they were conservative, they were not sort of ready to invest in growth. But what we're seeing in the US over the last sort of 24, 36 months, we do some surveys on small business optimism there. We are seeing levels we have not seen since the Reagan administration back in the 1980s. So the combination of economic strength, low unemployment, tax reform has been very beneficial for small business owners. And we're seeing some of those same trends here in Australia. So all of those numbers trending up and to the right in terms of expecting to grow in the next 12 months. That's often a catalyst for borrowing. People who actually grew, and then people who expect the local economy, the environment around them to grow in the next 12 months. So all in all, very positive trends in terms of small business optimism, which in turn should lead to increased adoption of online financing. From a government perspective, we've seen a number of initiatives now encouraging competition in financial services. It's no secret that Australia has one of the most concentrated banking systems in the world, the Big Four controlling 85% of the market. So you've got now the government's review into open banking. Very important. You've seen this in the UK, where open banking legislation can promote additional competition in financial services by opening up the data that's stored at the bank of a particular small business owner and allowing maybe competitive products to access that data to provide another offering. Also, this is really, really important. I was talking to the folks from Equifax just earlier. Positive credit bureau reporting. So this is called the CCR project here, or CCR reforms. I cannot overstate how important this is for the development of your market here. So in the US, positive credit data about small businesses underpins a substantial part of our OnDeck score, which we've iterated into over now the last 10 years. I think in the UK, we've had positive credit bureau reporting for quite some time as well. And you really will see, it's very simple. Imagine if you were looking at a job applicant and all you could see were the things they did wrong over the years. You wouldn't hire anyone. But if you can see the things they did right, you might actually hire a lot more of them. And so it's not rocket science. For small business owners, this is an incredibly important step. And I think in Australia right now, the scope of this is really only consumers. We would very much advocate for that scope to be expanded to small businesses so more credit can flow to them. And then you obviously have the Competition or the Productivity Commission's recent report. We'll come back to that a bit later. But how important it is for fintechs to be a competitive force in the Australian banking system. And then you have had a number of your politicians go on road shows around the world. I actually met with your treasurer in the US not too long ago. There's also been delegations sent to the UK to look at regulatory best practices. So these are all very proactive efforts by your government to go out and figure out what's working around the world and then bring those best practices back to Australia. I would also like to comment, though, on self-regulatory efforts. And before I go to the top part of the slide, maybe I'll talk about the bottom. So in the US, this took us a long time. Frankly, in retrospect, it took us too long to organize ourselves as an industry and focus on issues, whether it was sort of society-based issues, whether it's political issues, regulatory issues, issues of cooperation. And what I'm really encouraged by is Australia, only a couple years into the industry's development, is already self-organizing here. So in the US, we have this Innovative Lending Platform Association. It's all the online small business lenders. It's about 12 of us. That membership will probably grow to 15 or 20 companies by the end of the year. And we've standardized loan disclosures that have now been rolled out across all of the online lenders. This model called the SmartBox, straightforward metrics around rate and total cost. That SmartBox model has now been pushed up into Canada, and the Canadian Lenders Association is adopting it. And we are looking at potentially adopting something like the SmartBox here in Australia by the end of June. But these self-regulatory efforts are very important because what it shows is that the industry can work together to solve some of the critical problems it faces. And if the industry is proactive, then the regulators don't need to be quite as proactive themselves. And I think you can wind up with a much more harmonious relationship between government and industry if the industry works together to take these steps. Okay, so moving to what's next. What do we expect to happen in the next couple years as online lending to small businesses in Australia continues to develop? The first really has to do with the exponential growth. So just looking back for a second, we're looking at an industry that did $10 million or so of annual volume. These are numbers from KPMG in 2013. And in 2016, that had grown to 220 million. And then the numbers afterwards are OnDeck estimates. We estimate based on our own growth and the growth of other players in the industry, we're going to do collectively, 400 million of volume last year. 2018 could be around 700 million of annual volume just here in Australia. So that CAGR looking back is around 150%. And so even if you cut that CAGR in half, basically, and look at an 80% growth rate for the next kind of 3 years, you wind up with an industry that's much bigger and much more impactful than the industry we have today. So we're estimating around 80% per year moving on to 2020, a potential $2 billion in annual loan originations just here in the Australian market, and that's just online balance sheet small business lenders. So very, very exciting to watch this growth take place. With growth will come scale and consolidation in the industry. And I love this chart because it really sums up just about every online lending business in a single slide. So on the left here, you have your contribution margin per dollar loaned. So that's for every dollar you put out to a customer after your cost of funds, after your credit losses, what is your contribution to fixed overhead? And then you look at your originations volume on the x-axis as your scale factor. And so the different models in online lending, sort of plot in different parts of this chart. And what you see is that lower left, obviously, if you're not capturing a lot of unit economics and you're subscale, it's very, very tough for you to survive. And in the US, for example, in the last, call it 12 months, there's 6 different platforms now have gone, essentially, they've been playing in that lower part of the scale and were unable to survive. They've been consolidated into other players or they've shut down. And some of that will probably happen in Australia as well. If you have a lot of contribution and not so much scale, you can build a niche business. And we see that in the US in certain pockets. Certain vertical industries are focused on by different players, and they capture a lot of economics because of their specialization. Maybe that industry doesn't have a lot of alternatives out there, and so the margin capture is relatively high. And then, of course, to the right side of the chart, you have the scale players. And typically, when you hold loans on balance sheet, you capture more economics than when you sell them off to investors. So the risk is also the reward. But either one of those models we've seen scale up in the US now and become quite successful. So no doubt in my mind, as we look towards 2020 in Australia, you will see some consolidation in the industry. Partnerships are so important, and OnDeck has been very fortunate in Australia to partner with MYOB, the leading accounting software company here. It's a perfect match because accounting software is where the financial profile of a business is stored. It's a trusted relationship, and we've had a lot of success with a program called MyOb Loans, powered by OnDeck, and where through the MYOB relationship, we're presenting loan offers to customers under their brand, and the adoption there has been quite strong in the last year. So that's accounting. But there are other types of partnerships you can strike as well. In the US, for example, we are powering, as OnDeck, JP Morgan Chase's online small business lending program. So Chase has a Chase-branded product where OnDeck is providing the technology, the underwriting, the servicing, and frankly, a lot of the customer service and collections even for certain parts of that program. To JP Morgan has been very successful, growing at a very high rate. We just partnered with Visa to enable faster funding to merchants. And I think what you'll see in the Australian market, intermediaries play a very strong role. Loan brokers or associations of loan brokers, a very important way to reach small business owners. You'll see more partnerships there. And I think over time, lending will get more and more integrated to all of these touch points that small business owners use to run their business. Point of sale, payroll, and supply chain, I think, are just 3 of many possible integration points. The data and operating environment will continue to mature. So by 2020, I think we will have industry-led standards for conduct and disclosure. I think positive credit bureau data, knock on wood, would be great to have for consumers and small businesses. Hopefully we can push for that. Open banking deployment and adoption, that will take some time to get implemented. But once it's there, I think you'll see an explosion of competitiveness in the market. Real-time access to government data, something we're working on in the US as well. Haven't cracked the code yet, but data, for example, I think it's the ATO over here, it'd be the IRS in the US. Getting that data through an API, real-time, would make a huge difference in online lending decisions and validating what our customers are saying to us over the online application. And then finally, capital markets acceptance. A huge part of this is the raw material that funds all these online loans. It comes from the capital markets. I'm very pleased to say last week in the US, we closed a $225 million securitization that we think actually has set the record for the lowest cost of capital for an online small business lender in the world. So we received a AA rating from a rating agency at an all-in cost of about 3.75%, despite rates having gone up dramatically in the last couple years. So that's where we've gotten to now in the US. It will take Australia a number of years to still go up that maturity curve, but as that cost of capital comes down and as the asset class is more accepted, in turn, that should help grow origination substantially. Okay, so driving to 2020, just to put it all together. For small business owners, look, the most important thing is that small businesses are going to win big. The more options that are in the market, the increased choice will enable better fit to purpose and wider access to credit. As online lenders get profitable and scale up, that creates a virtuous cycle where they can invest more in their product offerings and improve that customer experience, making it fast and friction-free. And these ecosystem partnerships, I think, are going to be a big part of the landscape here in 2020. So it's not just reaching small business owners on your own as an online lender, but in concert with the touch points that all these small businesses use every day to run their business. And for the industry, I think we'll have a developed, responsible lending environment. So no longer the Wild West, so to speak, but really an environment where the regulation is more mature, the industry is self-organized and is cooperating in some of the critical issues that we face, and there's standardized codes of conduct and transparency. And so I think as all those things come to pass, we're going to wind up in a great place. So this is a quote from the Productivity Commission that I thought was especially relevant. Although a very small part of the financial system, fintechs represent a group that could fundamentally change the nature of competition in the banking system. And I believed that to be true 10 years ago when we started OnDeck back in the US. I believe it to be true today. I think it'll be even more true in 3 years here in Australia. So with that, thank you all very much. Appreciate it.
Have you got any time for a few questions now? Right. Remember I explained earlier on there's an online section called events at events.altfi.com. You can ask questions there. There it is appearing on the screen. It's very easy. You can do it anonymously if you want. So are there any questions to know? I'm sure. I'll kick off with one. How did you manage to get your cost of capital so low in America? That's a big advantage for you, isn't it? But how did that work? I mean, obviously you've been in the business for 10 years, you know. But are there any other kind of for people in the audience about how to get their cost of capital down?
Sure. Yeah. No. It was a 12-year overnight success story, right? It's one of those things. No. So it really is a combination of factors. I will say the 10 years of lending experience was a big deal. You go on the road show and you're talking to credit funds who will take a little bit more risk. They're maybe willing to lend to you when you have 3 years or 5 years of experience. But when we were talking, we had some insurance companies, very old established companies investing in the securitization. They really want to see that longer track record. And because our loans are shorter term, we were actually able to show them not only is it 10 years of history, but we have 8 or 9 years of completed performance vintages now available. I think the other thing is important is as we scaled, we turned profitable at the end of last year. And so the perception of these online lenders as capital-consuming entities, so switching from being unprofitable to profitable, I think really reduced what was perceived as the franchise risk of lending to us. And I think also I don't want to take full credit. It was a hot market. So I think that also helped too. So sometimes the wind's at your back, sometimes it's in your face. We were lucky that the wind was at our back.
Okay, cool. Just in case, I've got one question up here now. I'll read it out to you. A second, my eyesight's so bad I've got to walk over and look in front of it. What makes a good partnership for OnDeck or any other online lender?
What makes a good partnership? So we've tried a lot of stuff over 11 or so years in the US. And I think we've had the most success when we are working with a touch point with the small business where it's financially related. So, when someone's working with MyOb, let's say here in Australia, it's a financial relationship, it's a trust relationship. And so the idea that maybe because of that accounting relationship, you might be seeing a marketing solicitation for a loan feels very natural. We've done some other partnerships in the US with different brands, and the brands are also quite strong in small business. They're quite strong with our demographic, but they don't have that financial relationship. So I don't want to call anyone out here, but we've tried some where the customer sees the marketing solicitation for a loan and they feel like that doesn't match up. Like a good example might be like a broadband ISP, right? So you have an internet service provider providing internet access to your small business, but you may not expect a loan or a financial offer to come from that type of player. So I think that's a big part of it. And obviously having data about the small business owners matters a lot. So the more data you have, the better you can target.
One more question. And if anybody's got a question, one of my colleagues is lurking around over there. Put your hand up and we will find you. But in the meantime, I will ask this one question. What are the characteristics of the online lenders that failed recently? And what is the biggest risk for SME lenders? Probably related questions, I imagine.
It's So we have the pessimistic questions coming out here early in the morning, which is good. No, so in all seriousness, I think it gets back to that slide I showed. You can't have it both ways. You can't have poor unit economics and low volume and be successful. If you have not so great unit economics, you need an awful lot of volume to make up for that. Or on the flip side, if you have great unit economics, you still need at least some volume to have a viable business. And so I really think that this is a business where the advantages go to the scale player. The scale player can raise capital at lower prices, can optimize their marketing better, can build better credit models. And so if you fail to achieve that scale in a reasonable amount of time, and what we've seen is a venture capital kind of pullback from the sector as valuations have rationalized and as there has been a bit of a shakeout, I think that's a challenge. I think the biggest risk for SME lenders in Australia, I think just responsible growth might be the part of it, right? So as you mentioned earlier, David, anyone can take an online application. I'll be candid. Anyone can give away money online to total strangers. It's the getting it back that's the key part of this. And so I think, looking back over the last, 10 years of OnDeck in the U.S., there were times when I certainly wanted to chase growth on the margin that in retrospect that I shouldn't have, and there was really no need. And so I think, we do see a very dramatic growth rate ahead of us. 80% is nothing to be, ashamed of. If anything, it's something to be celebrated. And so if we could grow at that rate responsibly without a major credit event for the industry, that would be a good thing.
Any more questions? I will get one more question, this gentleman here at the front.
No, just a question on how you dealt with self-regulation in the US. I think we're seeing quite a lot of stacking happening here in Australia. Just your views on that and how you got lenders in the US to come on board with not that practice, which clearly hurts small business.
So the question is, from a self-regulatory perspective, how do you deal with the issue of stacking? And for those of you who aren't sort of from the online small business lending industry, what stacking is a situation, it could be initiated by the merchant, could be initiated by a lender, where you take a loan from lender A, and within minutes or days, you add a loan from lender B, and neither lender A or lender B is necessarily aware of the other entity's presence. And so, look, I think there are some codes of conduct we created as the ILPA, as this sort of self-regulatory body that helps. It also gives you a forum to resolve any disputes, right? So if someone is breaking away from the pack in not a desirable way, you have sort of a mechanism to initiate a discussion with them and bring them back in. I think also what we're going to see, and this really gets to the positive credit bureau reporting, is it's not crazy to think that in a mature market, there will be some coexistence of these players in a single merchant. So I have 2 credit cards in my wallet. One is a MasterCard, one is an American Express. Are they stacking on me? Not necessarily, because they're aware of the credit limit that each has offered me and my current balance on each. And so I think in a mature market, you're going to see coexistence of products, but it really depends on that positive credit bureau reporting to be done in a responsible way.
2 very quick questions, then we must finish. One from here already. What's the best route for origination in the US? And a question for me. You've talked about working with American banks, JP Morgan. Have you talked to any Australian banks?
Yeah, so very much on the second question, certainly we've talked to Australian banks over the years, and I think I'm probably not in the best position to comment on the current status of those discussions. What I can say is that in the US, not only have we inked and scaled this partnership with JP Morgan, we have a second major bank. We haven't announced the name of the bank yet, but we expect to later this year. And we have a really robust pipeline of some national banks in the US and some international banks as well. So
do you think though you'll have a relationship with a bank in Australia in the next few years?
It's I will defer to my excellent and extremely experienced Australian team on that one. But I think, look, regardless of whether we do or not, I think the industry will continue to scale. I do hope, though, that Australia can potentially follow the lead of some of the other markets around there and potentially see some very productive partnerships.
Last thing, best origination channel. Had to pick one origination channel. What's the best one in the US?
No, you can't do that. I think all of our channels, no, I can't give you the answer there. I think all of our channels in the US are first loan profitable, and they have some different pros and cons. So for example, when we work with brokers, the average loan sizes are bigger because people want a more consultative sale. When we work with strategic partners, the acquisition costs are lower because the strategic partner already owns the customer. And when we work in our direct channel, when a customer comes back for a second loan, maybe several years down the road, the acquisition cost is almost zero. So I think, and they stay with you longer too because you've acquired them directly. So we are unique in the U.S. in that we have all 3 of those channels operating at scale, and that actually creates a really nice dynamic because you don't have to, if conditions are poor in one channel, you can move your activity to another channel to offset any weakness. and stabilize your growth.
Okay, I think we've run out of time. Fascinating presentation. Noah, thank you very much for coming along today.
Thanks, David.
Thank you.
Appreciate it. Thank you.
Thank you very much. Thanks, Noah.